Hello, everybody. Welcome to Talk About House. I'm Todd.
I'm Juana.
Okay, today we're going to talk about the Fed rate cut, what that means for mortgages. And then we have a lot of very cool data on homeowner equity and the number of people that are upside down and all that. And historically, we're going to go over a ton today. We've got some pretty cool charts.
Okay.
Talk about all of it.
Okay, let's do it.
Okay, so here's the headline from the article. Fed slashes rates aggressively with larger half-point cut, prepare for lower mortgages. I thought what was interesting was they'd pulled like 114 economists, and 104 of them said 25 basis point or a quarter percent, and then 10 said a 0.5%, and it ended up being 0.5%. That just kind of shows sometimes that sometimes people's estimate of what they think is going to happen is not super accurate. We're talking like economists.
Right. So, look, I think economists looked at it historically, and historically over the last almost 40 years, I guess, the Fed lowered rates by 0.5 point only twice, and that was right before recessions. So I think economists thought that if the Fed lowered the rate 0.5 point, then that would signal a recession, and the Fed would not want to alarm the markets in that way. Obviously, the Federal Reserve Board decided that 0.5 point was the appropriate measure, regardless of what the markets might think that signaled. It was not a unanimous decision. There was one Fed governor that did not agree and dissented, which is really rare. That hasn't happened since like 2010, I think.
Mm-hmm. Yeah. Okay, so what you're probably asking is, how does this affect mortgage rate? So mortgage, we got a chart showing in a second. Mortgage rates didn't instantly drop 0.5%.
No, so mortgage rates anticipated this, and we've talked about this a lot. Remember, mortgage rates anticipate the market, and they kind of get ahead of it. So immediately, there's no earth-shattering change. What this communicates to the market is that the Fed will continue to lower interest rates. So again, the market will be far forward-looking, and you will see mortgage rates drop a little more, again in anticipation of more rate cuts.
Okay, here's a chart. This is the relationship between mortgage rates and federal funds rates since 1990. Now, what's interesting here is the crash bros don't ever like to see this chart past 2000. Because they could say the interest rates have never been this high. That's what they were saying a couple years ago. Interest rates have never been above. But if you look at this chart, literally pretty much 100% of the time before 2000, interest rates were above 6.2%. Like 6.2% would have been unheard of prior to January of 2000, all the way probably back to the 1960s.
Right, but the thing we have to keep in mind is that the crash bros, no offense intended out there to anyone, the crash bros tend to be under, let's say, 35. So within their adult life, they're right.
About 5 years. And most of them, actually, we found this out. We did some research. About 87% of the crash bros live with their parents. They're in the basement. So they live in their parents' basements. They've never actually owned a home.
Okay, well, we haven't quite documented that one, but that's Todd's research.
Yeah, I think that was my research, independent research. Okay, I think this is interesting because what is really interesting about the chart is you could see when interest rates were going up. And here, let's look at, if you go back to January 2004, and the Fed was raising rates pretty heavily all the way up to basically sometime in 2006. But look at interest rates. The little red line, the mortgage rates, they didn't change very much. They actually didn't really go up. They just kind of went sideways. So the federal funds rate went from like 1% to over 5%, and mortgage rates basically stayed the same almost. That's pretty interesting. What you got is that spread. The risk premium was like less than 1%. And then as you can see, great financial crisis, the Fed had to drop rates to basically zero and leave them there for 8 years maybe. But look at mortgage rates, didn't really decline very much. They declined like 1% or 2% over a decade. Went from like 6 to 4%. And then, but you can see this interesting. So don't expect, first of all, I don't think the Fed will go to zero. I think they'll probably go to 1 or 2. And I still think mortgage rates are probably getting up. Even if they hit 4 or 5, if you look at this chart, 4 or 5 is ridiculously historically low for mortgage rates. Now, with that being said, Juana, I did see this other article. And we're going to talk about it a little. This was the headline of the article. The magic mortgage rate that could psychologically jumpstart the housing market. Juana, most people buying a home, it's an emotional decision.
Look, buying a property which you will occupy is an emotional decision every time, whether we choose to admit it or not. It's an emotional decision every time because we have choices and we make that choice based on financial considerations. But at the end of the day, it's the emotions that tip the scale.
6.2%, that's the current 30-year fix. You can get VA loans in 5.5, 5.7. 15-year fix is in the low fives. We're probably just a few months off from 15-year fixes under 5% for in change, right? How do you think this works out in, say, next spring when maybe you can get a mortgage, a 30-year fix for the average person under 6, like 5 something? Do you think once people see a 5, they maybe go, okay, now I want to jump in the housing market?
Well, I think sellers are going to kill it and buyers are going to bite it.
Okay, why is that? Let's talk about that for a little bit. We know that 37 million people last year said they wanted to buy a house. Only about 4.1 million did. Why did only 4.1 million people buy a house when there were 37 million people saying they wanted to buy a house?
There weren't homes for them to buy.
Oh, there weren't homes for them to buy. So it wasn't that the interest rates are so high no one wants to buy a house.
No.
Basically, every home that was on the market eventually sold.
Yeah.
Pretty much.
To kind of go back to what I said, that the sellers are going to kill it. As interest rates go down on your, median home, sellers are going to be able to charge a premium that basically puts the mortgage payment slightly below where it was, a few weeks ago, but they're going to make up that difference. So here's what I mean by that. Let's say, for the sake of argument, that somebody, 6 weeks ago could have afforded a half a million dollar home, $500,000 home. And what's going to happen in the spring? Well, I think that same home is going to go to closer to $600,000, and that seller is going to pocket the $70,000 to $100,000 in premium, because that borrower is going to be paying about the same as they would have paid a few weeks ago with the current and the anticipated interest rate reductions. And that's what I mean that sellers are going to kill it, and that's what I mean that buyers are going to bite it. Now, the reason they're going to bite it is because interest rates change, but the price that you pay for your home doesn't. So buyers are going to pay more, and sellers are going to get to pocket the difference. So that was my prediction.
This is what I think is interesting. If I told you today, 100%, you could lock in a 6.2% loan on a $500,000 house. But if you waited a year, you could get a 5% loan, but the house would be $600,000 and your mortgage payment would be the same. There's a lot of people out there who go, oh, I got to wait for the rate to go down. I want a lower rate. I'm always stuck at 6.2. But the payment's the same. You're borrowing less money at 6.2%. If it was $1 and it was 10%, would you say, oh, no, I can't pay 10%? Right? So I think there's a lot of psychology in this with that number. And I think you're right, Juana. I don't think the houses are going to flood the market. And this is why. If somebody's finally saying, fine, interest rates are low enough, I'll sell this house, go buy another house. Sell a house, buy a house, you're adding another buyer. So if you only have 4 million buyers buying a house and people start selling, say another 1 million people decide to sell their house, now you've got 1 million more buyers. Here's the problem. If you're selling your house, you've got a ton of equity that everyone else out there doesn't have. We call this the California problem. The California problem is you're trying to buy a house in California and you marvel at how come I can't get a house? Everybody's coming in with cash, 50% down. And then the truth is they're selling a house in California that they've lived in for 20 years. They're buying a different house in California. And so California is like one of those markets where Californians don't have a problem buying. It's people that maybe are moving there or something like that haven't, if you lived in Tulsa, Oklahoma, and you made $300,000 on your house, that's great, but that's not going to get you a house in, La Jolla. Okay, this is what's funny. I'm going to show you this. Saw this post on X, the website formerly known as Twitter. Now, this was Crash Bro. Came up in my feed. Okay, here's the quote. Mortgage rates should head toward 4% by end of 2025. If you wait, you can snag some good deals 20 to 30% off. Rent for now. Home prices are going to fall very soon. Conservative estimate is for a 30% decline by 2025. Okay, 2025 is a couple months away. The housing crash, home prices didn't even fall 30% nationally. And it took like 4 years for the price to fall like 27%. Mm-hmm. Okay? We are not going to have, I'm telling you right now, no one knows what home prices will do. They're not going to fall 30%. Here's what's funny. This is the response. Home prices are not, this is not me. Home prices are not going to fall 30%. Once interest rates drop, demand for homes increase and prices rise. Which of those do you agree with, the Crash Bro or this other guy?
The guy that says once interest rates drop, demand for homes will rise, and so will the home prices.
Okay. With that, let's talk about homeowner equity. So I think what's interesting here, let's talk about first average equity gain. Okay, this is a map of the U.S. I'm going to read the thing at the top. Our picture's blocking it. For the second quarter of 2024, the average U.S. homeowner gained approximately $25,000 in equity during the past year. So if you own a home, $25,000 more equity on average. This shows by state. Maine was $58,000, the highest. California, $55,000. Jersey, $53,000. I have relatives there. I don't know why they live there. 3 states posted annual equity losses: Texas, Oklahoma, North Dakota. They were small amounts, 3 and 8,000. We're over here in Nevada, $36,000. If you look at this chart, it gives you a pretty good idea of, what happened with average equity gains. And then Florida, remember, the Crash Bros last year were beating up on Florida, saying Florida was going to crash, up 22,000 on average. So Florida really hasn't crashed. And most of that Texas number you're seeing is just Austin, because Austin has had a lot of sales and a lot of negative appreciation, or whatever you want to call it. This is actually not like out of the realm of what normal home prices should probably appreciate at, right, Juana? I mean, we're talking about median home in California is $1 million. So if you went up 5%, which is about what home prices went up, you gained $55,000 in equity.
Which is reasonable.
That's pretty reasonable. Okay, yeah. This was the cool one, though, because we have some cool data on this. This is negative equity share. What this shows, now when you see the red, it looks, oh my God, this is like climate change. Red is bad. Oh my gosh, it's like, if it's 80 degrees, it's in red, right? It's the hottest it's ever been in the world because it was 80 in July. Okay. This is the percentage of homes that have negative equity. This is not, they're in foreclosure. This is not even they're missing payments. They have a higher loan than they have equity in the house. Juana, at the peak of the housing market, do you remember what the negative equity was, either nationwide or Nevada, roughly?
So nationwide, I think there were about 23% of homes where people owed more than what the home was worth. So that's a substantial amount. That's almost a quarter. Okay.
So you basically have 3/4 of the people who are like, I still have equity, I'm fine. And then you have 1/4 of the people who are like, this is now not making any sense. Maybe tactical default. They just walk away because there's no recourse in most states, right?
Right.
Do you remember what it was in Nevada at the peak?
Yeah. So at the peak, Nevada was around 51%. So
over half.
Right, over half. So that's why, Nevada got hit so hard. And that's why we had a lot of foreclosures. We had a lot of loan modifications, a lot of short sales. And Nevada actually started early. Nevada ended up being kind of the weather vane of the whole thing. Yeah. Now, the thing that I want to point out is that most of this actually happened not just because of the initial loans that were provided to the borrowers, the borrowers were not well qualified, but what happened subsequently, that initial loan. So I believe that national numbers are like something like only 3% would have been upside down, meaning that they owed more than the home was worth if they had not taken out a home equity loan. And what did they do with those home equity loans? Anecdotally, we met people obviously while we were doing REOs.
While we were foreclosing.
Right. They did things like buying an RV, buying a boat, buying SUVs, going on bucket list trips, doing all kinds of things that would be consumed, had no return on investment, and then they would have to pay back if they ever paid back the loan. So think of it this way. They use their home as a piggy bank or as a credit card that then they strategically walked away from. They strategically walked away from the debt that they incurred. Not something that a lot of us are taught to do. We're taught to be responsible and own our debt.
What's interesting here is, remember, Nevada was at over 50%.
Yeah.
It's 0.7%.
Right.
0.7%. And then even like Texas, remember Texas had home prices declined a little bit, so the average amount of equity declined, and but still only 1.7% of people in Texas owe more on the house than the house is worth. None of this data is out of line historically. As a matter of fact, if you look at even California is 0.7% and Arizona is 0.9%. If you look at this historically, there has never been a more solid housing market from a perspective of the people's equity, how much they owe, their ability to pay. Here's another interesting thing. The number of 90-day lates, people who are 90 days late on the mortgage, 0.4%. That means 4 in 1,000 people are behind 90 days on the mortgage. That doesn't mean they're being foreclosed. That doesn't mean any of that. It is the lowest ever recorded. And remember, that's 0.4%. So we're going to do some math in public. Okay. 0.4% of people with mortgages, not all homeowners. Okay, Juana. If everybody has a mortgage and 0.4% of everybody, if everyone has a mortgage on their house, is 90 days late, then what percentage of all the houses are 90 days late?
Less than 1.
Right, 0.4%.
Right.
Okay, here we go. Let's say half the homes are free and clear. So half the homes are free and clear. They don't have mortgages. The other half, if half the homes have a 0.4% late payment, if you take that and spread it over all the homes, now what is?
Basically nobody.
It's basically nobody. It's 0.2%. So remember, we have 43% nationally. Nevada, we have over 50% of the homes are free and clear. People aren't late on their mortgage. We know in Nevada we have lowest number of foreclosures that we've literally ever had. So when you see these sort of negative reports, just look at these numbers and say, does this make sense? Like, how is Florida going to have a housing crash when 99% of people have equity? They're not going to just, I've got all this equity in the house. I'm just gonna sell it and dump the house and drop the price and just get out of it. People don't do that, right?
No.
Okay, Juana, here's the last thing. If you have a 3% loan and you're making $1,100 a month mortgage payment, I don't care if you lose your job or you get behind in payments or what. What is your incentive like to keep that loan going and that low payment going versus extinguishing that loan and going and renting for? Because remember, the Crash Bro said, don't buy a house, rent. I'll bet we can find 20 tweets starting in 2019, 2020, 2021, 2022, 3 that all tell you home prices will be down 30% next year. Just keep renting. Don't buy a house yet. They'll be 30% off next year. We've been hearing that for 5 years.
I think you probably find 20 tweets a day, not for the year, but yeah. I mean, look, anything negative draws a lot of eyeballs, draws a lot of attention, draws a lot of responses. So people like to put out negative information. They get actually a positive feedback loop out of it. So that's a lot of the reason why people do that. Common sense, data, and truth, they're not sexy.
5 of the last 7 recessions, home prices have gone up during a recession.
Right.
Because interest rates start dropping. The Fed starts reacting to negative news in the economy. Interest rates drop. Because home prices, to some extent, the buyer demand and everything is based on, it makes it a little easier if interest rates are down. This actually is going to make it easier next year. We've been stuck for the last 2 years at 4 million home sales a year, which is historically really low. which is why prices have gone up really. If we'd sold 6 million houses last year, home prices probably be flatter down. But we haven't. We've only sold 4 million. And now we're in this scenario where we're going to incentivize more people to come in and buy. Maybe some people that have homes will sell, but then they'll also be a buyer. Right? They're not just going to sell. They're going to sell because they want to buy, and they don't want to trade their 2% loan for a 6% loan, but maybe they'll trade their 2% loan maybe they'll trade their 4% loan for a 5% loan, right? So you'll get some of those people who do it. Okay. With that being said, what do you think next spring or next fall look like? Oh, there was one other thing that was really interesting. Mortgage applications increased in the last week from last month.
Right.
That is a surprise, because September and October are usually the slowest weeks of the year for mortgage applications.
Right. But people, again, are looking at what's happening with interest rates, and they're thinking, okay, this is my chance. Plus, of course, we are coming into the magic week.
Where?
Yes. All over the country. The witching week.
The witching week.
The witching week. Zillow talked about this.
Yes.
It's the magic week.
Why is it magic?
Zillow, through its magical 8-ball algorithm, decided that the magic week to buy a home this year is the tail end of September, beginning of October, because they have figured out that that's when we're going to have the most inventory, the most incentivized sellers, the most price reduction, the most, with some toast, probably not avocado toast, and that's the time for you to find a home. I'm less than convinced about that, but it certainly makes for a fun read. But regardless of that, we are looking at borrowers that maybe have been sitting on the fence for some time, and they're looking at this opportunity. Maybe there's a small uptick in inventory in their market, and they're thinking, okay, this is my time. There's a little more inventory. I think there's something out there for me. So they're looking at mortgages so they can buy a home.
I think so October is statistically the month nationwide where there's the most inventory. There's less homes on the market in November than there are in October. This is almost literally every single year.
Right.
I think it'll be interesting to see how fast, because we have right now half of the number of homes we should have in Las Vegas available for purchase. We should have like 6,000 in Vegas for purchase. We have about 3,000.
Right.
It's going to be I think it'll be brutal here next spring. It will probably be at 1,500 at any given time, homes to purchase, and most of them will have multiple offers on them if you have 5% interest rates.
So inventory will start decline toward the end of October as we start hitting holidays and people start taking their homes off the market for the holidays. So that's the reason why we have less inventory, from the end of October through the end of the year, because of the holidays. Now, it doesn't mean that those homes don't sell. So let me give you an example. Let's say you take your home off the market. Now, a smart agent is going to look at the homes that came off the market, and if that home might be a fit for their buyer, then what they'll do is they'll contact that listing agent and say, hey, I see your seller took the home off the market. Would there be a possibility for us to see it? We'd really be very interested in the home. And a lot of times those sellers will allow the home to be shown, and the home will actually sell. Because remember, at that point, you're dealing with a super interested buyer. So you're definitely going to have a better chance of that buyer buying the home. Now, that doesn't mean that every buyer is going to do that. And it doesn't mean that every buyer's agent will think out of the box and look at the listings that recently came off the market. But that is a strategy if you're working with a buyer's agent, to ask your agent to say, hey, look at homes that have recently been taken off the market. Let's see if any of those might be a fit, and let's see if we can get in and take a look at them. And then we won't be competing with anybody else when they come back on the market in the spring.
The best thing that could happen for the housing market in 2025, if you're a homeowner, is for there to be an actual recession. Man, we've been hearing about 5 years about the recession. Okay, actually have a recession. The Fed would crank rates down super low, mortgage interest rates would drop, and buyer activity would pick up, and home prices would keep going up.
I don't know that would happen right away. I think the Fed might be a little more patient, particularly since we're dealing with a contentious election and all the turmoil that brings to the market.
Yeah, but the election's less than 2 months away.
I understand.
We're like 6 weeks away from the election.
I understand that. I think that all of that takes a while to percolate through the economy.
Okay.
All right. So fun times. Hopefully this was interesting and fun. Please leave us your real estate related comments. We appreciate them. If you're interested in buying or selling anywhere in the country, or especially here in Las Vegas, please reach out to us and we'd be happy to help you. Remember to like the video, subscribe, hit the notification bell, share the video, and we'll see you on the next video. Bye.
Bye.